Hey everybody, Smart Silver Stacker here. Taking a look here at the 5-day chart of the spot price of silver. And as you can see, kind of a rough week for the precious metals. On Friday, there was a major drop in the price of silver and gold as well. And that followed a speech that Federal Reserve Chairman Jerome Powell gave at Jackson Hole. This was a very hawkish speech. Jerome Powell essentially reiterated the Federal Reserve's commitment to hiking interest rates however high they need to fight inflation. And he talked about the dangers of reversing policy early. And I think he's doing a little damage control. You know, he had come across as somewhat dovish in previous speeches recently. And I think he wants to tamp down some of that enthusiasm in the markets that seem to be anticipating an early Fed pivot. And one of the things that he talked about extensively in this speech was inflation expectations and how high inflation expectations among the public can become a bit of a self-fulfilling prophecy as people tend to spend more quickly, contributing to inflation, increasing the velocity of money if they anticipate that inflation is going to get higher or remain high. And I believe that this hawkish speech, the whole point of this is to control inflation expectations. And the Fed is actually doing a decent job of that. I think they're doing a better job of controlling inflation expectations than they are of actually controlling inflation. And you can see that in this recent survey of consumer expectations conducted by the New York Fed. The median 1-year and 3-year inflation expectations both declined sharply in this survey in July. And the decline was for the 1-year inflation expectation from 6.8% down to 6.2%. And in the 3-year ahead inflation expectation in the survey, it declined from 3.6% to 3.2%. And so the American public seems to be under the impression, they have the belief that inflation is going to decline, the Fed is going to be successful in their fight. And I don't think that that expectation is really based on anything in reality. It's based on all the jawboning from the Fed and all of the lip service that they have been paying to, their fight against inflation. And it seems to be that that is working for now. But that can only work so long when the fundamental problems surrounding inflation are not actually addressed. And sure, the Fed has been raising rates. Of course, compared to how high the inflation rate has gotten, doesn't seem like they've been that aggressive in raising rates. And also, the government has not changed their inflationary fiscal policy. So even if the Fed is increasing the tightness of their monetary policy, which should help to combat inflation, the government is continuing these massive deficit spending programs. They're continuing to borrow money and spend it into existence. And so that is a highly inflationary policy. You have to fight inflation from the fiscal perspective and the monetary perspective if you want to get that under control. And recently, we got this plan proposed by the current administration to forgive student loan debt, about $10,000 per borrower. And the University of Pennsylvania's Wharton budget model here in this article is forecasting that that's going to cost about $329 billion over the next 10 years. And of course, it's not like we have $329 billion in the coffer to spend on forgiving student loan debt, and so this is all going to be financed, paid for by the printing press. And it's just one example of how the fiscal policy of the federal government is not going to contribute to fighting inflation. In fact, quite the opposite. Just like the Inflation Reduction Bill that we just got that was almost $500 billion, that is going to contribute to inflation. It's going to do exactly the opposite of what the name implies. But that's nothing new. That is sort of how these government programs work. And we're going to talk also about how the Fed has not really been tightening policy, despite the fact that they've given it a lot of lip service. But real quick, I do want to say a big thank you to today's video sponsor, Silver Botanicals, household and personal hygiene products that utilize the power of nano silver. We've still got that promotion going on for a couple days. If you use the link down in the description and you buy more than $50 worth of product from Silver Botanicals and use coupon code STACKER, you're going to save 10% off your order, and you will receive a 90% silver, brilliant uncirculated Roosevelt dime as well with your order. So go check them out today. And if you like these videos, you want to support the channel, the best ways to do that is to support our sponsors. Like I was saying, the Fed is not really doing much to fight inflation. Sure, they're raising interest rates a little bit, but mostly it does seem to be a lot of hot air coming out of Jerome Powell and others at the Fed. And you can take a look at this chart of the Fed balance sheet going back to January of 2020. And, they're supposed to be engaged in this big quantitative tightening program that they keep talking about. If we take a look at the peak of the balance sheet, $8,965,487,000,000 back in April 13th of this year. And since that time, supposedly they keep talking about this quantitative tightening, how they're going to normalize the balance sheet. Well, where are we at today? Well, the latest data from August 24th shows that right now we are at $8,851,436,000,000. So that's a reduction of about 1.2% over the past 4 months. And already, the economy is heading into a recession, and I have no confidence that the Fed is actually going to reduce its balance sheet in any meaningful way. This just shows that their fight against inflation is a lot of talk, and they're not really taking the actions that they are describing. This quantitative tightening is just going to get more difficult as we move forward, as the Fed continues to raise interest rates. That's going to put upward pressure on Treasury yields, and selling Treasuries into the market, of course, would also put a lot of upward pressure on that. And this is going to be at a time that the federal government is trying to finance all of their deficit spending by issuing more debt. And so, it's just not going to work. We're going to eventually see a spike in interest rates, or the Fed's going to have to come into the market and buy more debt. And I think that that is probably what we actually will see when quantitative easing becomes the norm again rather than quantitative tightening. And I forecast that, we're going to see $9 trillion, $10 trillion, $11 trillion on the Fed balance sheet a lot sooner than we're going to see $8 trillion. Now, also, it's not just our own Federal Reserve and government that are continuing to wage war against the dollar. We've also got the BRICS nations internationally here. A little BRICS update for you. Russia and India have now announced that they have eliminated the US dollar from their bilateral trade, and that they are now settling their bilateral trade in a new mechanism using rubles and rupees. So this is, just another one of these small blows against the dollar. It's death by 1,000 cuts for the dollar and the dollar's world reserve status as this process of de-dollarization continues. And, the BRICS nations, not only are they eliminating the dollar from their bilateral trade, but they also have been talking about creating a resource-based alternative reserve currency. I did a video on that last week. You can check that out, about how Putin is talking about this new Moscow world standard to compete with the LBMA and Western commodities markets, and how possible even that the new BRICS currency could have some kind of metals backing or commodity backing. And so, this is going to really be a long-term threat to the US dollar. This whole Brix Alliance of the emerging markets could really threaten the dollar status as the world reserve currency. This is an article from oilprice.com that was published recently that highlights just how extensive this Brix Alliance could become. Of course, right now it's Brazil, Russia, India, China, and South Africa. New applicants include Egypt, Saudi Arabia, Turkey, Algeria, Bangladesh, Indonesia, Mexico, Nigeria, Sudan, Syria, Pakistan, and Venezuela. That is the list of countries that is considering membership, or they've expressed interest in joining the BRICS nations. And so, you start talking about Saudi Arabia and Iran and Russia all being in an economic alliance together, and that is a tremendous portion of the world's energy production. This group has a tremendous portion of the world's population, tremendous portion of the world's manufacturing, and the fact that some of the key leaders here, like Russia and China, are now taking a decidedly anti-dollar stance. This is the sort of thing that is laying the foundation for the decline of the US dollar. And it's not the sort of thing that happens overnight, until it does, because what we're seeing now is this foundation is being laid for the dollar's downfall. And this may take a while to go into effect, to sort of gel this opposition to the dollar. But then once this foundation is in place, all it's going to take is some kind of a black swan event to drive the dollar over the edge. And that is the kind of situation that it looks like we are getting closer and closer to, if you ask me. Of course, it's a wild world. Anything could happen, but it seems to me like the dollar is continuing to come under attack and its days are numbered. And that's why I'm still stacking silver. Silver down to $18.77. I mean, that's pretty cheap. It would be interesting to see if we dip below 18, or if that will continue to provide some support in the price of silver. I suppose with the Fed getting as hawkish as they, seem to be, at least, the perception that they're putting out that they're getting hawkish, because I don't think they're actually very hawkish at all. I mean, the interest rates remain historically very low. They haven't approached anywhere near the level of interest rates that Paul Volcker, had to raise interest rates to back in the 70s and the 80s to get inflation under control. But it's all about market perceptions and expectations. And you can see that when the Fed makes a speech like they did on Friday, the markets move. And if the Fed came out and made a dovish speech tomorrow, markets would move up. And nothing's based on fundamentals anymore. It's all based on the perception of what the Fed is going to do. They're what is driving markets. But we can use that to our advantage, because when you look at the fundamentals and you actually consider what's going on with the economy, I think it becomes pretty clear that precious metals are tremendously underpriced at today's levels. So let me know what you think in the comments down below. Thank you all very much for watching, and I will catch you next time. Smart Silver Stacker, out.